Welcome back, everyone. We have an update from NCS Multistage Holdings, Inc. It trades on the NASDAQ under the symbol NCSM. It is a leading provider of highly engineered products and support services that facilitate the optimization of oil and natural gas, well construction, well completions, and field development strategies. Please welcome its CEO and director, Ryan Hummer. Nice to see you, Ryan. What's your update today?
Thanks, Anna. Good to see you as well, and thanks for having us back. So yeah, we'll spend just a few minutes on the update, and then want to leave open some time for Q&A. And we did present at this conference in May, so I will just give a quick reminder on who NCS is, give an update on our strategy and the execution of our strategy, and some of the financial performance for the year. So maybe before we dig in detail, I'll spend a minute just talking about who we are and where we're focused. I think that was a good introduction, Anna. We're a technology-focused oilfield services and equipment company. So what we do is we sell directly to oil and natural gas producers. So companies like Exxon, Chevron, Conoco, Devon, Occidental, Varen, similar customers like that. And our competitors include companies like Schlumberger or SLB, Halliburton, NOV, Core Lab, and other competitors. And within that market, we tend to focus on certain areas where we can obtain a leadership position and earn attractive margins for the work that we do and the products that we bring to market. We focus on innovation and partnering with our customers to bring new solutions to market that will save them time, save them money, or help them make better and more productive wells. So we pair this focus on R&D and innovation with a capital-light business model. We outsource the manufacturing of the vast majority of the components that go into the products that we sell. We do perform assurance checks and oversee the assembly on those components before they go out to the field to ensure quality and reliability. But this has helped us minimize capital investment requirements in our business through the years and generate free cash flow through the cycles. So as I mentioned before, we did present in May, so I'd encourage anyone who's interested in a more detailed overview of the company to review that presentation. We also just released earnings this morning, so you can view our most recent investor presentation, listen to our earnings call transcript and press release to get a very current update on the business. So my comments today are really going to focus on the progress we've made in implementing our corporate strategy and how that's impacting our results. So the three core business strategies for NCS are provided on this slide. We introduced this strategy throughout the company in 2022. And I think we'll be able to demonstrate that the positive results from the implementation of this strategy are becoming clear. The first strategy that you'll see is to build on our leading market positions. So for us at NCS, these leading market positions include our position in fracturing systems on a global basis. That is our largest product line. Also, our presence in the Canadian completions market and our strong resulting customer relationships there. And also our global capabilities and presence in our tracer diagnostics product line. The second core strategy for NCS is to capitalize on offshore and international opportunities, which we've been pursuing and investing in. So this is a focus for us for a number of reasons, but primarily because international and offshore customers in particular tend to buy based on the technical characteristics of what we can provide, as opposed to simply price competition for us versus other competitors in the marketplace. There's also an ability to build stickier relationships with those customers and work with them over multi-year periods. And as a result of both of those, we can tend to earn and be better compensated for the value that we provide to those customers. The third strategic component that you see here is to commercialize innovative solutions to complex customer challenges. This is really the core to what we do. We obtain and understand the voice of the customer, emerging market needs, and we work through our product strategy and engineering teams to deliver solutions that can bring tangible value to our customers. So I'll highlight for just one moment, there are a couple of charts on this slide, but the progress that we've made in growing our revenue outside of North America in 2024. We're on track to meet or exceed our prior record for international revenue in any year in our history. And our international revenue as a percentage of total should reach 10% this year, which is up from about 5% last year. This has been a big investment, both in time as well as resources to grow and penetrate these international markets, but it really is starting to pay off. And I'll give a little bit more detail on how we're seeing that pay off for the company on this slide. So really, this shows how our targeted growth strategy and our business model can help to deliver really compelling results for our shareholders. At the midpoint of our guidance range, we expect to grow revenue by over 10% this year. And this is in a market where in the United States, the rig count has been declining for the last 18 months or so, and that's an indicator of industry activity, while activity in the Canadian market and international markets have been flat to up a little bit. So a 10% revenue growth is something we're pretty proud of. And what this growth enables is a slight increase in our gross margin percentage. I mentioned earlier that we outsource most of our manufacturing, so you can think of our cost of sales as being highly variable. But in contrast, our operating expenses, or SG&A, is relatively fixed. So what that does is it allows for really significant operating leverage as we grow. And you can see this, it's demonstrated on this slide by the 49% increase in EBITDA through the first 9 months of the year as compared to last year, and our expectation that we'll be able to grow our full year EBITDA by over 60% in 2024 on a top line increase of only 10 to 11%. Another note is that we do expect that our free cash flow will inflect higher this year versus prior years. And our free cash flow through the first 9 months is about $4 million higher than the comparable period last year. So we're on track to meet those objectives. So I'll just close on this. This is the last slide that I'll speak to by saying that I think we offer a very compelling opportunity for investors. We're delivering EBITDA growth with strong incremental margins. You can see on this slide, we have a strong balance sheet. We've got a net cash position of just about $7 million at the end of the third quarter, and expect to further strengthen that through our free cash flow delivery this year. With the midpoint of our guidance for free cash flow being about $6 to $10 million, the midpoint $8 million, that would be an 18% yield on the equity. So it's a nice upside from free cash flow there. I also think that while we have these unique growth characteristics, we're also a value play. We've got a discounted trading multiple compared to some of our peers. Our equity value is below net working capital, so I think there's a good margin of safety for investors. So characteristics of a value company, but get to play some of the growth inherent in the technology that we're bringing to market and the market share gains that we're making. So that's really it, Anna, I guess, as far as our presentation. When I spoke last year or early this year, it was more of an introduction to the company and introduction to the strategy, but did want to give an update and show how that progress is paying dividends for us and for our shareholders.
Wonderful. Thank you so much. Yeah, we do have some questions. You mentioned having a leading market position in the completions market in Canada. So why is this important to your business?
Yeah, great question. So Canada was really the first market to adopt our fracturing systems technology. And again, that's our largest product line. About 60 to 70% of our revenue is through our fracturing systems product line. So Canada remains our largest market globally. We believe that we participate in somewhere between 25 and 30% of the wells that are candidates for our technology in Canada in any given year. And as a result, we earn about 60% of our revenue from Canada. Recently, the Canadian market has been a better place to operate than the US as a result of infrastructure developments up there that support our customers. There's been a new oil pipeline, which has allowed our customers to realize better oil prices. And there's a new LNG facility that's coming online next year, which will support natural gas-driven activity in the market. So we think our relatively high exposure to Canada is really a benefit right now, and think it'll continue to work to our benefit over the next several years.
And what has driven the significant increase in your international business this year? And do you believe that can carry forward into the future?
Yeah, thanks, Anna. So international markets can have very long sales cycles in our business. It takes a long time to engage with the customer, have them understand the solution, the technology that we're bringing, and find applications for it. So we have been pursuing growth in the North Sea and in the European market, North Sea in particular, and then also in the Middle East for the last several years. And our international business is really starting to inflect higher this year. And I think this year it's really led more by that Middle East activity. So last year, we did about $8.5 million of revenue outside of North America. We've already done more than 12 million this year, and think we'll be able to push to 15, 16, maybe even a little bit more. So almost a doubling of activity outside of North America. And as we look forward to 2025 and beyond, we think there's still room to run in the Middle East as we bring more of our product lines into that region. And also, as our work in the North Sea, we've spent a lot of time the last few years growing our customer base. Historically, we'd worked for 2 customers in the region. This year, we'll work for 5 and expect that number to continue to grow. So as we add those new customers and our existing customers expand their scope of work, we think there's still good room to run for us in international markets.
Wonderful. And as you grow revenue going forward, what incremental margins do you think might be achievable?
Yeah, thanks. I mean, that's a really important question. We've made changes to reduce our cost base in late 2023. So the impact of those cost reductions, together with some increased income related to technology that we've licensed to other industry participants, has actually enabled us to have incremental adjusted EBITDA margins in 2024 of about 50%. Now, I think that's a bit of an anomaly. We're benefiting from those reductions that we made in the past and that additional royalty income. But going forward, we do think we can still generate very attractive incremental margins as we grow, primarily by leveraging those relatively fixed operating expenses. And also, I think as we think through in the longer term, a good level of adjusted EBITDA margin on an incremental basis would be, call it 25 to 20, maybe 20 to 30%, 25% at the midpoint. So really accretive, really profitable growth as we continue to pursue new technologies and enter new markets with our technology.
Wonderful. Well, great update. Thank you so much. And we would love to continue to follow along with your journey.
All right. Appreciate it. Thank you. And thank everyone for joining and listening.
Wonderful. Thank you. Okay, everyone, stay with us. We have our last presenter.